Hi, today is Sunday 13th and I won't have time during work hours to record this video. I couldn't last week, so it's gonna be what I have on Sunday, and this is the close of Friday from IB, so that should be okay. I'm starting now with the October trade. The October trade is recovering okay. If you remember from the other video, SPX Outlook, it was quite an unusual experience, and let me show you again. We had a very strange volatility behavior when the market shot up to 3600, and so this trade was not doing so well, although not in endangered territory here, but I think I went for a I went for some trade reduction. We were up about 16 or $18,000 of capital usage, now down to 668, and I intend keeping it this way until we have a more predictable market. Price wise, the market is fairly predictable. It should just grind down and maybe eventually fall. But at this point, the market is still behaving okay. There's no urgency in managing trades very actively. And basically, what I've done is that I went for a risk reversal some time ago. On the put and call side here, I added a CCS and I removed a PCS, so basically one PDS, one PCS. Not much impact on delta, but I just wanted to keep the overall capital usage low. Delta flat of a large range, and this trade does not need much attention for a while. If I look for T plus 7 for the coming week, 1SD is doing good, 32.17 to 34.64. From the SPX outlook, I think the market would bump on 34.45 maximum, and on the way down it should go for 32.80 and maybe lower later on. So this minimal exposure to volatility is actually a good thing, and this white structure also have a more distributed vega. So this is not your typical broken butterfly. It has morphed into something that is butterfly plus condor, and as you can see, there may actually be again more sensitivity to vega if we were to go for another market anomaly with vol up, with the vol going up when market also grinds up. At this point, I believe the market will just drift down, and it can of course go in selling waves, but at this point 31.25 is a very strong support even on short-term time frames. So on this one, not much to do. If the market keeps just falling, we can lift the upper expression line while also shifting risk on the upside, basically doing further risk reversals. At this point, nothing much to do. Theta is, of course, a little bit low on this white structure, but it's fine. And if I were to close it at T plus, let's say about 11 to 14 days to expiration, nothing wrong. The profit will not be great until at the same time, with capital usage remaining low, I may just keep it up to expiration exactly the way I've done for September. So let's have a look at September. September was, of course, a little bit more sensitive to the up move. It lost a bit more. I mean, I had less cover, I think 1 or 2 weeks ago. I covered only to 35.50, so when the market was going up, it was not doing so well. It is true that I don't really like being delta positive, so this trade may also need some risk reversal. We had only a few days left, and I decided to roll it to September 30th, where I actually expanded the tent all the way to 3600, and those broken butterflies I rolled to September on lower strikes. Not as safe if the market would fall rapidly to 31.25, so this trade may need a little bit of attention, but overall I would be happy with 165 loss on this one. And of course, because volatility is still high, there's still a lot we can do. So it could be plain risk reversal, maybe with a short butterfly here to move the strike lower, and we can, of course, this one won't yield much. At Friday's price, it was just a very small credit, which means that in order not to lose too much on potential recovery, I would maybe go, as you can see, these ones are still quite expensive, so I would have to roll them by doing something like this. If we do that, capital usage remains the same. We just flatten delta, and the profit potential is about the same. This is a more classical structure with, at the same time, still fairly wide. As you can see, the Vega exposure is not right there where the broken bridge line is. So this is a typical structure where you control your delta without having too much to worry about how Vega could actually make your delta and your T plus 0 sink. So this one is okay. We've got a fair amount of theta. So I am not worried on this one. It's a bit unfortunate that I had to roll, but this is a fact of life, the market. By rolling, I actually got some extra theta. As you can see, just a little bit credit, costs down to 140. So we're getting close to break even. And we've had a few good months, so I don't mind losing a little bit on September. These are the touches I'm intending to do. I don't think anything drastic is needed right now. But of course, if the market would fall much more rapidly than anticipated, then I would have definitely to do a more aggressive risk reversal and maybe even a more sizable rollback here. Lastly, let's have a look at the November entry. November was okay. With vol up, we had a good setup to enter the trade. Okay, some of you say, well, this is no longer a Rhino. And for those who were members of the class, I said, well, the ruling guide or ruling principle for the Rhino is to overall, and more specifically for the entry, is to have a flat delta over the largest possible range. So I looked at prices, and when I wanted to enter closer to the money, I would have had some positive delta. And really, I didn't need to go for. This is not like the RTT previously. I'm not sure the RTT is so popular these days, but that really, I don't mind starting with a small debit. And also, with volatility being high, it's actually cost effective to go for wider structure that usually costs more. By going wider, you have a PDS, this side, to PCS ratio that goes closer to 1. And this means that even though the Rhino is always quite resilient during the first 2 to 3 weeks, it is even more so with wider structures. And this week I added just a CCS that was 1 SD away. If we look, it's probably still, you see the delta. I mean, it was a good entry. I entered when the market was around 34, 20 or 30. I'm making a bit of profit on this one. There's no need to change, but yeah, of course, we could think of rolling it down to still stay in the 20 delta range. So now up to expiration, the 1 SD should be around here. So this one is so safe, I can maybe roll them, wait, or add another one. I could even go for an additional one here, say around here, and gradually just raise the per expiration line. I'm quite happy that 60 days away, we have already almost $400 of 10 value, and it could go up by 4 points to 735. So this trade is doing okay. -2 delta, there's technically nothing to do. This would not even increase capital usage, although there's ample capital available. So yes, I could, in this growing phase up to, let's say, about 49, generally 56, but sometimes 49 DT, add capital. And in this case, that would not even add capital. It was just a way to raise the upper exponential line up to astronomical value. Right, so there's not much else to say. There is no scaling rule in this new approach that is more adapted to high volatility environments. Yes, we are looking at keeping a delta flat over a large range. So because the market does not hover within a given range, not even a range that would be even 50, 60, 80 points. I mean, the market dropped 300 points last week, recovered 100 points, lost another 100 points. So volatility is high, and there's no indication that it's going to be range bound for in the foreseeable future. Even if I was to look for adding theta, an additional structure closer to the money, where I would have more theta and a quicker delta, a negative delta building up, that just doesn't happen these days. So I would rather go for flat delta, increasing the profitability of the trade. And of course, if the market would be a little bit more reasonable and just be range bound, maybe 31.25 to 34.45 for the first time in the last 2 years, maybe, we would have the possibility of delta growing, and then I would look for an upside hedge. But at this point, I am not interested. Let's not forget that upside hedges are generally localized and definitely not very appropriate for this type of market. So I'm not looking at call calendars. I'm not even looking at called butterflies to hedge the upside. I would go for straight CCS with maybe a PCS, which means a 9 condor. That's also a possibility. Again, capital usage is low, so yes, I will look at increasing into this trade. At the same time, I don't like having 3 trades to look at, and now that I've rolled September to end of the month, I may just keep this one easy to handle so that there's little management so that I can focus on September or over the next 2 weeks. Okay, that's it for now. Thank you for watching. And if you want to ask questions, send me a message direct or on the channels on my Rhino Slack there most of the day, and that's definitely the best way to get hold of me. This Rhino tutoring is free, and so it's always time permitting on my side. I am quite busy as a quant trader, researcher, and also mentor in my firm, and we're also busy restructuring it as a family office, so I am very, very busy. So please understand that my time is limited. Okay, have a good Sunday and see you on Slack. Bye bye.